मीटिंग हुई, क्या आप लोगों ने डिसीजन लिया?
Today we had a meeting to discuss about the Tamil Nadu political situation, basically post-election scenario. Honorable Congress President Mallikarjuna Kharge ji, LOP Lok Sabha Rahul Gandhi ji, in charge Girish Chowdankar ji was there. The President of TVK, Vijay, has requested the INC for support to form a government in Tamil Nadu. INC is clear that the mandate in Tamil Nadu is for a secular government committed to protecting the constitution in letter and spirit. The INC is determined not to have the BJP and the proxies run the government of Tamil Nadu in any manner. Thiru Vijay has spoken about drawing inspiration from Perum Thalaivar Kamaraj also. Accordingly, the Congress leadership has directed the TNCC to take a final decision on Thiru Vijay's request, keeping in view the sentiments of the state reflected in the electoral verdict. That's all. Thank you very much.
Can you repeat the last line?
Last line is very clear.
Directed what, sir?
The Congress leadership has directed the TNCC to take a final decision on Thiru Vijay's request, keeping in view the sentiments of the state reflected in the electoral verdict.
मीटिंग हुई, क्या आप लोगों ने डिसीजन लिया?
Today we had a meeting to discuss about the Tamil Nadu political situation.
Subscribe now.
Inspiration from Perum Thalaivar Kamaraj also. Accordingly, the Congress leadership has directed the TNCC to take a final decision on Thiru Vijay's request, keeping in view the sentiments of the state reflected in the electoral verdict. That's all. Thank you very much.
Can you repeat the last line?
Last line is very clear.
Directed what, sir?
The Congress leadership has directed the TNCC to take a final decision on Thiru Vijay's request, keeping in view the sentiments of the state reflected in the electoral verdict.
मीटिंग हुई, क्या आप लोगों ने डिसीजन लिया?
Today we had a meeting to discuss about the Tamil Nadu political situation, basically post-election scenario. Honorable Congress President Mallikarjuna Kharge ji, LOP Lok Sabha Rahul Gandhi ji, in charge Girish Chowdankar ji was there. The President of TVK, Vijay, has requested the INC for support to form a government in Tamil Nadu. INC is clear that the mandate in Tamil Nadu is for a secular government committed to protecting the Constitution in letter and spirit. The INC is determined not to have the BJP and the proxies run the government of Tamil Nadu in any manner. Vijay has spoken about drawing inspiration from Perum Talaivar Kamaraj also. Accordingly, the Congress leadership has directed the TNCC to take a final decision on Vijay's request, keeping in view the sentiments of the state reflected in the electoral verdict. That's all. Thank you very much.
Could you repeat the last line, sir? Could you repeat the last line, sir? Can you repeat it? Please repeat last line. It's not clear.
Last line is very clear.
Directed what, sir?
The Congress leadership has directed the TNCC to take a final decision on Vijay's request, keeping in view the sentiments of the state reflected in the electoral verdict.
ठीक है, थैंक यू।
Very, very
That
good.
मीटिंग हुई, क्या आप लोगों ने डिसीजन लिया?
Today we had a meeting to discuss about the Tamil Nadu political situation, basically post-election scenario. Honorable Congress President Mallikarjuna Kharge ji, LOP Lok Sabha Rahul Gandhi ji, in charge Girish Chowdankar ji was there. The President of TVK, Vijay, has requested the INC for support to form a government in Tamil Nadu. INC is clear that the mandate in Tamil Nadu is for a secular government committed to protecting the Constitution in letter and spirit. The INC is determined not to have the BJP and the proxies run the government of Tamil Nadu in any manner. Vijay has spoken about drawing inspiration from Perum Talaivar Kamaraj also. Accordingly, the Congress leadership has directed the TNCC to take a final decision on Vijay's request, keeping in view the sentiments of the state reflected in the electoral verdict. That's all. Thank you very much.
Could you repeat the last line, sir? Could you repeat the last line, sir? Can you repeat it? Please repeat last line. It's not clear.
Last line is very clear.
Directed what, sir?
The Congress leadership has directed the TNCC to take a final decision on Vijay's request, keeping in view the sentiments of the state reflected in the electoral verdict.
ठीक है, थैंक यू।
Very, very
That
good.
मीटिंग हुई, क्या आप लोगों ने डिसीजन लिया?
Today we had a meeting
welcome to Unacademy IAS. This is Sham Kagod here, taking up the Indian economy session of Conquer Prelims Initiative covering the current affairs from January to April 2026. Now, before I start the session, please do let me know that I'm audible and visible for all of you. Those present in the session, please give the confirmation. Am I audible and visible for all of you? Done. Thanks a lot. Let's begin the session. Before I start, here is a very important announcement. During this particular session, where I'm going to discuss all the relevant current affairs topics from the subject of Indian economy, which are selected from different newspapers. I don't want you to keep on sitting and writing down the notes. Don't worry about the PPT. Don't run behind taking the screenshot of the slides that I've prepared. Let the session be over. After the session is over, you will get the PPT, whatever I'm using here, along with the notes. But I want a commitment from your side. During this session, whatever the length of the session, could be 3 hours approximately, you will sit and listen to the session very carefully with utmost attention. And after the session is over, you will download the PPT as well as the notes from my Telegram channel and use it for revision. These are the two commitments from your side I want. Let me begin the discussion. Before that, right now the Unacademy IAS courses are available at the lowest ever prices of 16,999. Those interested in enrolling, do check out the details by clicking on the link provided in the description below. Once you enroll into the course, you will get access to the live sessions as well as the recorded lectures, the prelims test series as well as the mains test series, the reading material, UCAN current affairs initiative, etc. Do not miss out. This is the lowest ever prices. Use the code IAS English, and I've been told that the offer is going to end on 30th April. Let me begin the discussion. First important topic, the changes that the MOSPI, Ministry of Statistics and Program Implementation, has announced in the context of the GDP calculation. The GDP calculation. Now, what are the important changes? First and foremost, the base year, which was earlier 2011 and 2012. Now the base year has been shifted to 2022 and 2023. This is the most important change. And by the way, please listen to me carefully. As such, there is no law to mandate that there has to be or there must be a revision in the base year. There is no law. But the convention or the practice has been that generally once every 5 years, I repeat, once every 5 years, the government makes a changes in the base year, not just the base year, but also the methodology to calculate, right? The way the data is collected, etc. After the 11 and 12, which was adopted back in the year 2015, the adoption of new base year happened in 2015. That is 11 and 12. Now, after more than a decade, the base year has been changed to 2022 and 2023. This is the first and the most important change that you need to remember. Second very important change, double deflation method. Double deflation method. What is this double deflation method? And before I continue with the discussion, if you have any doubts, please hold on to your doubts. After every half an hour, I'll take a pause from the discussion, ask you to paste any doubts you have. Right? Do let me know if you have any doubts when I ask you to. Double deflation method. What is this double deflation method? Listen to me carefully. When you calculate GDP from 1 year to the next year, you take the market prices, correct? You simply take the market prices. But can I simply say the market prices of the commodities from 1 year to the next year will change? That is basically because of inflation. Until now, in lot of the cases, we used a concept called as a single deflation. That is, what was the output? Understand this carefully. In most of the cases, we used a single deflation method. That is, what was the output? We basically adjusted the market prices of the output by taking out the impact of inflation. But this is problematic. Problematic in the sense, we are measuring the changes in the prices of the output and removing the impact. But there will be change in the value of the input as well. That is, the raw material that you have purchased would have changed from last year to this year as well. So right now, according to the latest methodology, we have introduced the concept called as a double deflation method. Under the double deflation method, not only the output, but also the input, whatever price changes they have experienced, both the input as well as the output, the price changes will be adjusted. This is basically called as a double deflation method. This is the second important change. Third one, we are using lot of survey based data sets now. For example, for measuring the output from the informal economy, we will collect the data through a survey called as ASUSE, Annual Survey of Unincorporated Sector Enterprises. This basically measures the output from the informal economic or unincorporated enterprises. This is one data set. In addition to this, we are also using the data set or data that we have collected from the household consumption expenditure survey. So more and more data sets to accurately estimate the GDP is going to be utilized. This is very important change. And one more very important change is when you look at the GDP calculation, all of you, I want an answer from your side, and this is what I expect from you. I want you to participate. When I ask you the questions, let me know the answer. When you look at the GDP methodology or GDP calculation, you will come across a term called as discrepancy. Yes or no? Do let me know in the chat section. Discrepancy. You will come across a term called as discrepancy. What is this discrepancy? You calculate GDP using expenditure method and you calculate GDP using the production or value addition method. And have a look at this. When you calculate GDP using both of these methods, you will generally see that there is a difference between the GDP that you get through production as well as expenditure method. There will be a difference. And that happens because, please understand, on one side you are collecting GDP data based on the expenditures that have been incurred, and on the other side you are estimating GDP based on the value addition. What if all the data regarding the production is not reported? What if all the expenditures that have been incurred are not accounted when you calculate GDP through, right, let's say the income method, etc. So there will be certain differences between both of these numbers. And to adjust for this, in the GDP through expenditure method, they will write something called as a discrepancy. They will essentially account for this by having a component called as a discrepancy. Now, larger the discrepancy number, the credibility of the GDP would be hurt. If the discrepancy itself is very large, automatically there will be doubts raised regarding the credibility of the GDP. So what has been done now in the latest methodology or the revamping that has been done by the government now says we are going to use a system called as supply use table. Yes, UT, and this is published by Ministry of Statistics and Program Implementation. Supply use table. And what is the use of the supply use table? Under the supply use table, whatever has been imported, the details associated with that will be available. Whatever has been sourced from the domestic market, the details of it will be available. And when I say imported, sourced from the domestic market, what am I referring to? I'm referring to raw material. I'm referring to inputs, etc. So whatever has been utilized for the manufacturing, you have a data for this. And once the final goods and services are produced, where they have been sold, to which market these have been sold, how much has been sold, all this data is available in the supply use table. So if you use the supply use table, can I basically now ensure that there is more synergy between GDP that I calculate using the value addition method and GDP that I calculate using the expenditure method. That's the reason the supply use table methodology has been adopted now. It was earlier there, but now under the GDP methodology, this has been adopted. This will help us reducing the discrepancy that is present in the GDP numbers. Is everybody okay? These are the important changes in the context of the latest methodology to calculate gross domestic product. Now, apart from this, what are the other things that you need to remember? Please look at the table here. All of you, please look at the table. For the first time, the GDP calculation, the base year that was used after independence, the decision was taken in 1956, and the base year that was used was 48 and 49. And this base year has been revised periodically. From 48 to 49, it was changed to 60, 61, then to 70, 71, then to 80, 81, 93, 94, 99, 2000, etc. So the base year has been revised 7 times after independence. And this is the 8th time the base year has been revised. Please remember this, can be asked in the prelims examination. And finally, listen to me carefully. When was the first time after independence? Let me ask you this question. Let me see how many of you will be able to answer. When was the first time after independence national income was calculated? Do let me know in the chat section very quickly. When was the first time the national income was calculated after independence? Do let me know. Anybody knows the answer? And I want the answer very quickly, by the way. Nobody is answering. Anyways, I'll write the answer here. The first time the GDP calculation was done in the year 1949 based on the committee that was set up by the government, National Income Committee. National Income Committee, right? So based on the committee, that was National Income Committee, and the National Income Committee was headed by Mr. P.C. Mahalanobis. P.C. Mahalanobis. And Mr. P.C. Mahalanobis is very well known, by the way. P.C. Mahalanobis is also known as a statistician. The Indian Statistical Institute. It is set up by Mr. P.C. Mahalanobis. P.C. Mahalanobis is also known for the second 5-year plan, second FYP, second 5-year plan. The second 5-year plan is known for heavy industrialization. Heavy industrialization plan. Done? Okay, so these are certain important things associated with the GDP changes. Please remember, right? Download the notes after the session is over, revise it. Let's go forward. Second very important topic, changes in the CPI. Changes in the CPI, Consumer Price Index. So we have two measures of inflation. One is the WPI, second one is CPI. WPI measures wholesale price index, that is the change in the prices in the wholesale market, and CPI measures changes in the retail market. The base year revision for the WPI is going to be done very soon. The committee has already been set up by the Government of India. Regarding CPI, the base year revision as well as the changes in the composition of the basket has already been done. So what are the important things that you need to note from the context of CPI? First and foremost, the change in the base year. Now the base year for CPI is 2024. Earlier, it was 2012. Earlier, the base year was 2012. Now, the base year is 2024. That is the first very important change. Second one is, earlier, please understand, we used to measure CPI in the form of CPI IW. CPI UNME, urban non-manual employees. We had CPI rural workers or rural labor, right, etc. But please understand, there was a committee that was set up by the government. Rangarajan Committee. Remember this. Rangarajan Committee. This Rangarajan Committee recommended that we should change the base year and we should have certain synergy. What is the logic? Why did the committee actually recommend this? The committee recommended this because it saw that, one, the base year for all these indicators is not the same. The base year is not the same. Base year is different. The basket is not the same. Basket is also different. And what does it represent? The inflation for which kind of consumers? That is also different. So considering all of these particular factors, Rangarajan Committee recommended that we should change the system. We should make a change in the system. How do we measure retail inflation? And that actually led to Government of India introducing a system of CPI, that is Consumer Price Index, that we use as retail inflation today. Everybody is okay? The retail inflation that we are using today is simply written as CPI. Of course, we have CPI rural, CPI urban, and CPI combined. But when you come across the term CPI in the newspapers, they don't have to justify that. By default, it is CPI combined. So CPI rural, CPI urban, CPI combined. That kind of a system was introduced by the government of India. Now periodically, like we change the base year for GDP calculation, we change how do we measure the data, etc. Same thing is done even for other indices, right? Take for example CPI. So what are the changes that has been done? Please make a note of this, and when I say note, a mental note, and revise it using the notes. Old CPI, the base year was 2012. Old CPI, the base year was 2012. New CPI, the base year is 2024. The basket of commodities or the basket of items earlier, 299 products were there. Now 358 products are there. Unlike WPI, in CPI we have goods as well as services. So 259 goods were there earlier. It has been increased or changed to 308. 40 services were there, changed to 50. These are the very important changes that you need to note. In addition to this, the food and beverages earlier in the CPI basket had almost 46% weightage. 64 is in WPI, that is for manufactured items. Anyways, so in food and beverages in CPI, 46% weightage. Now that has been changed to 37%. The core basket, earlier the weightage was 47%, it has been increased to 58%. Earlier, for rural housing, the rent that was paid, the rent data was not collected. Now, the rent data for rural housing as well, it is collected. These are certain very important changes. In addition to this, in CPI, how many, right, let's say groups are there? The commodities are there. Earlier 299 commodities or 299 items. These 299 items earlier were divided into 6 groups. Please remember this. These were divided into 6 groups. Now, the 6 group system has been changed. Instead of 6, we have total 12 groups. Is it okay? We have total of 12 groups. Remember this as well. All the 358 goods plus services now are divided into 12 groups. These are certain important changes. In addition to this, the changes in the weightages that has been done by the Ministry of Statistics and Program Implementation, because this is also published by MOSPI. The changes have been done based on Household Consumption Expenditure Survey 23 and 24. The movement in prices in the e-commerce platforms will also be tracked now. That will also be considered. And one more very important change, like I mentioned earlier, the rural rent expenditure will be considered. Your expenditure on subscriptions such as Netflix, Amazon Prime, etc., they will also be considered in the calculation of CPI. These are the important changes in the context of CPI. Everybody is okay? We have covered 2 topics now. Can I move on to the next topic? Please do let me know. Any doubts so far? Can I move on to the next topic? No doubts? Okay, great. Next topic, flexible inflation targeting. Third topic, flexible inflation targeting. Back in the year 2015, the Government of India as well as Reserve Bank of India signed an agreement, Monetary Policy Framework Agreement. MPFA, Monetary Policy Framework Agreement. Now, this particular Monetary Policy Framework Agreement introduced the concept of flexible inflation targeting. Priyan Nair, I'll answer, just give me some time. Flexible inflation targeting. What is this idea for flexible inflation targeting? Under the inflation methodology or under controlling inflation now, Reserve Bank of India will be made responsible for controlling inflation. RBI will be responsible for controlling inflation. And because we are asking the RBI to control inflation, Government of India will not unilaterally decide what is the inflation target. Rather, the government will hold consultations with RBI and then assign the target to Reserve Bank of India. The 2016 to 2021 was the first round of flexible inflation targeting, and then 2021 to 2026, second round of inflation targeting. And I hope all of you remember, although you're writing the exams in the next month, I hope all of you remember, we are in the year 2026. That is the third round of flexible inflation targeting will be implemented from 2026 to 2031. So year in that particular year where the third round of inflation targeting will be implemented. So what is the inflation target? The inflation target has remained unchanged. It is the still same target, that is 4% plus or minus 200 basis points. 4% plus or minus 200 basis points. What is the meaning of it? The Reserve Bank of India now will have to maintain the headline CPI. Please remember, headline CPI. Headline CPI has to be at 4%. But at all the times, you can't maintain the inflation at 4%. Certain flexibility has to be provided to Reserve Bank of India, because there will be certain external factors, internal factors, which are beyond the control of RBI. For example, take the current affairs, crude oil prices. RBI can't control crude oil prices. So flexibility has been provided, that is plus or minus 200 basis points. In simple terms, the ceiling level of inflation will be 6% and the floor level for inflation rate will be 2%. The same mechanism was applicable earlier, and the same mechanism is continued to be applicable for the next 5 years. But of course, please understand this carefully now. Before this round of inflation targeting was announced, Reserve Bank of India had asked Government of India to incorporate certain changes. RBI had asked Government of India, had requested Government of India, can you make these kind of changes? What is the change? If RBI is not able to meet the target of maintaining inflation rate for 3 consecutive quarters, RBI will submit the report to Government of India. Government of India doesn't disclose the report to the public. What has RBI told Government of India? Neither can you come to know, nor I being the fan of RBI, let's say the teacher for economy, I will also not be able to understand what has RBI told to Government of India. Right? So RBI had asked Government of India, can you make a changes in this provision? So that next time, it has not happened, by the way, after pandemic, it has not happened. Only once RBI had submitted this kind of a report to the Government of India, and that was during the pandemic. After that, it has not happened. But if at all it happens again, where RBI is not able to meet the inflation target, RBI has to give the written reply to government. The people will not come to know what was the reply given by the Reserve Bank of India. RBI said, change it. Let's promote transparency. Government of India has not amended it. There was one more request that was done by the government, by the Reserve Bank of India. There are 3 members, external members, who are appointed by the Government of India into the Monetary Policy Committee. Correct? I'm pretty sure all of you know this. MPC has 6 members. Of the 6 members, 3 are from Reserve Bank of India, and remaining 3 are from the experts who are appointed by Government of India. These experts are appointed by Government of India simultaneously for a 4-year term. Understand this. They're appointed simultaneously by the Government of India. RBI had told Government of India, advised Government of India, why don't we change the process? That is, instead of simultaneously appointing the 3 members like this, why don't we ensure that there is no vacancy simultaneously happening in the MPC? We will appoint them in a staggered manner. Right? Because all the 3 members, if they're appointed for 4 years, assuming all of them will complete their tenure, suddenly after 4 years, all the 3 members will have to be replaced because they cannot be reappointed. Remember this. They will have to be replaced. What if the Government of India delays the appointment process? What if elections are there? What if there is no government because there is no confidence motion, etc. Situations. So what if there is no appointment of 3 members? Delay happens, etc. So what RBI had recommended? Let's not appoint all of them simultaneously. Let's have a staggered manner of appointment, so that at any given point of time, if there is a vacancy, there is only 1 vacancy, remaining 2 seats are at least filled. That was the recommendation given by RBI. It has not been implemented. Done? Everybody is okay? These are certain important things in the context of flexible inflation targeting. Okay, now before I go forward, there was one question asked by a student, who publishes CPI? The publication of CPA is done by Ministry of Statistics and Program Implementation. MOSPI. Okay, let's go forward. Delhi government signs an MOU with the Reserve Bank of India. Delhi government has signed an MOU with the Reserve Bank of India. Now please remember this, important. I feel there will be a question asked on this. Reason being simple. Lot of concepts are involved in this. What is the point? I'm pretty sure all of you heard of one of the functions of RBI. What is the function? The Reserve Bank of India will act as banker to the government. Correct? All of you have heard of this, read of this, revised it, memorized it, etc. Right? So the Reserve Bank of India, one of the functions is it will act as a banker to the government. Under what section? Under what provision? From where does the RBI get its powers from, etc.? It is according to RBI Act of 1934. According to RBI Act of 1934, specifically Section 21. Section 21. But what if RBI has to act as a banker to the state governments, union territories, etc.? Then the section that you need to remember is the Section 21A, subsection 1. Is it okay? Section 21A, subsection 1. Please remember this. Fun entertainment says the Section 17. My dear, Section 17 is more associated with the investments that are supposed to be done by RBI. Where does the RBI invest? Section 17 talks about it. Section 21A, subsection 1 talks about RBI as a banker to the state government as well as union territories. Until now, listen to me now. Until now, Delhi government, right? This particular place, Delhi, did not have an agreement with the Reserve Bank of India. So what if the Delhi government wants to borrow? What if Delhi wants to get money, etc.? They would simply get it from the government. They would simply get this money from the government. And as such, Delhi did not have its own separate account. They did not have their own account. So what has happened now? With the approval of Government of India, Reserve Bank of India has signed an Memorandum of Understanding. Memorandum of Understanding with the Reserve Bank of India. And what is the use of this MOU? Using this MOU, if the Delhi government wants to borrow from the market, for example, the state governments will issue bonds, SDLs. Correct? All of you heard of this? State governments will issue bonds, SDL, State Development Loan. Now the state development loans of Delhi government will be issued by the Reserve Bank of India, auctioned by Reserve Bank of India. The money will be collected and transferred into the account of Delhi government. And this will happen for the first time. Everybody is okay? This will happen for the first time. This is the reason this article is important. But in addition to this, there is also one more concept, important one, right? Very, very important concept. There is a fund called as National Small Savings Fund, NSSF. Now this particular NSSF, what is the use of this? There are a lot of small savings where we invest, where you have invested, I have invested, lot of households have invested. For example, Sukanya Samruddhi Yojana, Kisan Vikas Patra, etc. Lot of these small savings are there. So when we invest this money into the small saving schemes, all of this money will be taken and put into a fund called as NSSF, National Small Savings Fund. It's a type of a public account. Please remember this. It's a type of a public account. Now from the NSSF, investments will be done because the returns have to be paid to the investors, right? The returns have to be paid to the investors. From the NSSF, lot of investment will be done. A lot of this investment was done into the central government bonds, central government as well as the state government. Is it okay? Everybody is able to follow the sequence here? Lot of this investment went into the state government bonds, central government bonds. In a nutshell, the state and the central government used to borrow from the NSSF. They simply borrowed from NSSF. But there is a problem with this. What problem. The rate of interest that the state government will end up paying will be much higher compared to the rate of interest the state government will end up paying by issuing bonds in the market. Is it okay? But basic idea. You borrow from NSSF, you pay rate of interest. That rate of interest is comparatively higher. Higher compared to what? Compared to the bonds that you issue in the market and you pay rate of interest in the market. That rate of interest is much lower compared to the rate of interest you pay when you borrow from NSSF. That is the precise reason, based on the recommendations of the 14th Finance Commission. Remember this, 14th Finance Commission. There is a 16th Finance Commission, but based on the recommendations of the 14th FC, this practice of borrowing has been discontinued. The states have been barred from borrowing directly from the NSSF. This was based on the 14th Finance Commission recommendation. But some of the states have been exempted from this as well. Some of the states have been exempted from this. Even today, they can borrow from NSSF. What are the names of this? Madhya Pradesh, Kerala, Arunachal Pradesh, and until now, Delhi. Until now, Delhi. Right? So there was this particular problem that if you borrow directly from the NSSF, you end up paying more rate of interest. Rather than this, issue bonds in the market. Borrow from the market. It will help you reduce the cost of borrowings. These are the two very important points in the context of Delhi as well as Reserve Bank of India signing the Memorandum of Understanding. Everybody is okay? Everybody is okay? Please do let me know. Sahil Suman, banker to the state government too? Yes, my dear. The state governments will have to sign an MOU with the RBI. Only and only then RBI will work as banker to the state governments as well, which has been done exactly now by the Delhi government. Okay, let's go forward now. Tiger Global, right? Tiger Global, the tax issue. This is topic number 5 now. Tiger Global, the tax case issue or the tax case. Supreme Court of India very recently has issued an order. And this particular order rattled the market, created a lot of confusion amongst the foreign investors, etc. What was the case? What is the issue? Simple. Please understand, let's say there is a company ABC in India. You don't have to remember the names of the exact companies. Just remember example here. Let's imagine there is a company ABC in India. The equity, I repeat, the equity, that is the shares. The shares of this particular company ABC have been purchased by an entity which is present in Mauritius. This is present in Mauritius. I'll call this entity as, let's say, company X. Not the, right, let's say Musk-owned company, any other company X. Now, this particular company has purchased equity in the company ABC, and it will transfer this, the company X will transfer the ownership of, or let's say the equity of the ABC to the original parent company of X. I'll call this as Z. Right? That is in fact Tiger Global. Right? There is a subsidiary, the Tiger Global, which is an American company here. Okay? This is an American company. This entity has opened a subsidiary, one more entity in Mauritius. And from Mauritius, the investments have been done in an Indian company to purchase shares. Is everybody okay with the sequence? Right? So some of you might be thinking, sir, why? What is the logic? Why are they routing the investment like this? My dear, tax benefits. Simple, tax benefits. Because there is a double taxation avoidance agreement between India and Mauritius. And under the DTA, the capital gains taxes, the long-term capital gains taxes are imposed and collected by the Mauritius government. And the tax rate is 0%. So obviously, the foreign companies who want to basically use the tax loopholes, wants to reduce the tax burden, they will route their investments from Mauritius into India. So in order to avoid the taxation, in order to reduce the tax burden, the Tiger Global set up a subsidiary in Mauritius, and this subsidiary invested in the Indian company and purchased equity. Now listen to me carefully. This double taxation avoidance Avoidance Agreement was amended in 2017. The DTAA between India and Mauritius was amended in 2017, and after the changes were introduced, Government of India had the power to impose the taxes on capital gains. Is everybody able to follow the story here? The Government of India will have the right to impose the taxes on the capital gains even though the investments have come from Mauritius now. Even though the money has come from Mauritius, if they make capital gains, Government of India, that is the CBDT, will be imposing the capital gains tax and collecting. But in order to protect, right, in order to protect the previous investments that were done, a grandfathering clause, a grandfathering provision or a grandfathering clause was introduced. What is this grandfathering clause? Grandfathering provision or a clause simply means even though the rules have been changed, even though the policy has changed, the same policy which was applicable earlier will continue to be applied. Simple, everybody is able to understand? Now, after 2017, CBDT will be imposing capital gains tax. But this would be applicable if your investments are done after 2017. What about the 2012 investments? What about 2013 investments? 2015 investments? They would continue to attract the same kind of a tax by the same authority before 2017. This is called as a grandfathering provision or a grandfathering clause. But the Central Board of Direct Taxes sent a tax notice to this entity that is present in Mauritius. They basically sent a tax notice. What was the tax notice? The company X transferred the equity ownership of the company ABC to Tiger Global. Right? They transferred the equity to Tiger Global. Now the CBDT looked at this and simply said, because you have transferred, transaction has happened, taxes are applicable, pay so much amount of tax. Tiger Global argued that after 2017, the tax methodology has changed. The authority imposing the taxes have changed. But there is a grandfathering provision. I am protected from these changes after 2017. I cannot be imposed these taxes. Mauritius Tax Authority has the right to impose, not the Government of India. This case went to Supreme Court of India. Supreme Court of India looked at all the process and simply said, the taxes will have to be paid by Tiger Global. The taxes will have to be paid by the Tiger Global. Why so? They basically said, don't focus on the structure of the contract. Don't focus on the structure. Focus on essence of the contract. Have you heard of, I'll just give you a connection here. All of you have heard of GAR? Please do let me know. GAR, General Anti-Avoidance Rules. Under General Anti-Avoidance Rules, the focus is on the substance of the agreement. The focus is on the substance of the agreement, not on form of the agreement. Apply the same logic here as well. Why did Tiger Global set up a subsidiary in Mauritius? It was to avoid taxes. So if you are making this kind of a structure to avoid taxes, I will not allow you to enjoy the benefit of tax exemption. I will impose and collect the taxes. Everybody is able to understand? So even though the grandfathering provisions were present, even though the DTAA earlier agreement allowed Mauritius government to impose and collect taxes, Supreme Court of India said these taxes will have to be imposed and collected by CBDT now. Everybody is okay? Please do let me know. Everybody is okay, right? So these are important points and somebody is asking, please tell important topics or facts. My dear, that's what we are doing topic by topic. Have patience. And somebody says, sir, talk about SEBI now. We'll come to SEBI. Let's go one after the other, right? Okay. So what are the important points from this article? Grandfathering provision can be asked. Double taxation avoidance agreement can be asked, right? Please be very careful. Let's go forward now. Next important topic, the Financial Intelligence Unit, FIO, Financial Intelligence Unit, the regulations that have been implemented in the context of crypto exchanges. Crypto exchanges. What are the important changes that have been done by the Financial Intelligence Unit? Please go through all of these points. Important article, by the way. The Financial Intelligence Unit, basically functioning under the Ministry of Finance, very recently, that is back in the year 2023, came out with set of guidelines which was applicable for crypto exchanges. Crypto exchanges. As of now, there is no single framework, right? I'll repeat this. As of now, there is no single framework covering all the aspects of cryptos in India. But it is true that we have taxes being imposed on crypto transactions. Whatever crypto transactions we do, taxes are imposed and collected on that by the government of India. So the Financial Intelligence Unit, India, has announced certain important changes. For example, first one, the FIU discourages initial token offerings and initial coin offerings. It discourages that. What is that initial token offerings or initial coin offerings? Lot of these crypto exchanges, that is basically they will offer you, open a crypto account with us, trade, right? Let's say using these crypto accounts in the crypto exchanges. But if you open the crypto account, we will give you so many coins. Correct? Have you heard of this? They'll say, just join and we will give you so many coins. You can, using these particular coins, you can participate in the crypto exchanges. Right? So FIU has said, no, you can't issue them. That is the first one. Second important one, tumbler or mixer. Tumbler or mixer. The tumbler or mixer, right, anonymity enhancing tokens linked to transactions will not be facilitated. What is this idea for tumbler or mixer? Let's say there are 10 people who have crypto wallets with an exchange. 10 people. Now, tumbler or mixer is a mechanism where the cryptocurrencies from these investors will be taken and it will be pooled and then it will be transferred to other investments or they will be invested somewhere. And what is the use of this? The moment you are using the tumbler or mixer, you will be able to ensure that from whose account we have taken the cryptocurrency, who is receiving the cryptocurrency from whom, all of this will remain anonymous. So the anonymity will be promoted by using tumbler or mixer. FIU says, don't promote it. We don't want all of these to be anonymous. We want more and more transparency. Third one, the other regulations also include better KYC norms. Better KYC norms. For example, if you open a crypto wallet, now the company which will provide you this particular facility, they will have to do a better KYC. For example, lively detection has to be done. Lively detection in the sense, live photo has to be taken and uploaded. Additional document has to be provided. The company has to ensure that this is not any other account, it's a valid account, etc. by conducting penny drop method, etc. So a lot of these regulations have been announced by FIU, which have to be followed by all the crypto exchanges in India. Right? FIU will be the single point regulator. The Financial Intelligence Unit will be the only regulator in India. All the crypto exchanges will have to be registered with the FIU. These are the important regulations or the changes that the FIU has brought into force in the context of crypto exchanges, right, very, very recently. Everybody is okay? Do let me know. Can the DTAA be revised or nullified by the government? Of course, yes. Jomi, yes, my dear. If the government of India wants to review the DTAA that they have signed with other government, they can do that. They can easily do that. Okay, let's go forward. The taxation, right? Two important changes in terms of taxation on tobacco as well as the pan masala. Pan masala as well as tobacco. What are the changes? Listen to me carefully. Until now, under the GST, I'm pretty sure all of you heard of this, there is a concept of compensation cess. Correct? There is a concept of compensation cess. GST compensation cess. This GST compensation cess, now the government of India has discontinued it. From 1st February 2026, the government said, we are going to discontinue GST compensation cess. But once you discontinue, the GST compensation cess, which was earlier applicable on lot of the demerit goods or sin goods. It was applicable for lot of demerit goods or sin goods. Because these were demerit goods and sin goods, the tax rate, that is in addition to GST, compensation cess used to be imposed, and the government used to ensure the tax rate is very high. And mind you, under the GST, the maximum rate of tax that you can impose is 40%. Under the GST, maximum rate of tax that you can impose is 40%. Now, with the discontinuation of the GST compensation cess, how will you be imposing taxes on pan, tobacco products, cigarettes, etc.? Government has to impose a higher tax. You cannot simply discontinue compensation cess and ensure that the market prices will be less. No, these are demerit goods. These are harmful goods. You'll have to impose a higher amount of tax. But under GST, the rate that you can impose maximum is how much? 40%. Just to give you an idea, the products such as, have a look at this, pan masala. The products such as this attracts how much tax? 88% tax. Right? Until the compensation cess was there, it used to attract 88% tax. Now, if you discontinue the GST compensation cess, maximum GST rate applicable will remain, if you continue with the same rate, 28. Even if you increase it, it will become maximum how much? 40%. But you'll have to impose higher rate of taxation on this. So in order to ensure that the tax rates will remain higher, the money that is collected by the government will remain higher, and these demerit goods will remain costlier in the market, Government of India has implemented or initially introduced a bill, Health Security Say, National Security Bill. This has been passed by the Parliament. It has become the act now. Under this particular act, now the tax rate on the pan masala products will be GST rate of 40%, GST rate of 40% plus 48% cess. Is everybody okay? GST rate of 40% plus 48% cess. This is the first important change. Second important change, the tobacco products. On the tobacco products, Government of India has implemented the provisions of Central Excise Amendment Act of 2025. And with this, although the compensation cess, etc. has been withdrawn, the government has ensured the tax rate will remain higher, the tax burden on the buyer will remain higher, and the government will continue to collect higher amount of taxes. They will continue to attract 40% GST. And I hope you understand all of this has happened because the Government of India has rationalized the GST structure. They have rationalized the GST structure. Right? The GST slabs earlier were too many. Now the main are only 2 slabs. In addition to the main 2 slabs, we have, right, 40% which has demerit goods or sin goods. The tobacco products, pan masala products, etc. all of them will come under the 40% slab. Everybody is okay? So Central Excise Amendment Act has been passed. The tobacco products will continue to attract 40% GST. In addition to this, there will be national calamity contingent duty, right, etc. These are some of the important points. Please go through this particular table. Don't memorize the numbers. Please go through this particular table. Right, here is the type of announcement that was done in the context of, right, the pan masala. Here is the tobacco, that is, right, let's say the cigarette products. Done? Everybody is okay? Can we go forward now? Okay, next one. Tax on petrol and windfall tax. Please remember this. The Government of India as well as the state governments, the Government of India as well as the state governments both impose taxes on fuels. Both impose taxes on fuels. Right, for example, on petrol, the central government will impose tax which is a specific duty. Correct? All of you okay? The specific duty, that is per unit taxation, per liter, central government will impose a tax on this. And the state government will also impose a tax. The state government will also impose a tax, but it is more of a VAT type of a structure. It is as a percentage of value of the petrol and diesel. So Government of India, in order to ensure that with higher crude oil prices in the international market, very recently, I'm pretty sure all of you know this, because of what is happening in West Asia, the crude oil prices have shot through the roof, right? Especially the crude basket for India. The crude basket for India on an average is over $100 per barrel. On an average is $100 per barrel. It is more than $100 per barrel. As a result of this, the import price, the import cost of the crude oil has increased. And when the import cost increases, automatically the market price should also increase. But the Government of India, in order to provide relief to the consumers, in order to provide relief to you and me, has stated that it will reduce the tax burden. It will reduce the tax rate so that the oil marketing companies will not have any kind of under recovery. And because they're having under recovery, they will not be increasing the market price of crude oil, or let's say the petrol and diesel in the market. Now, what are the important taxes? Please remember this. The taxes that the government imposes. Of course, I'm talking about only the central government here. The central government imposes the following taxes on petrol and diesel. Basic excise duty. This is the most important component. There is a special additional excise duty. This is what has been reduced by Government of India. I'll repeat. This is what has been reduced by Government of India. Third one is agriculture, infrastructure and development cess. And the fourth one is additional excise duty. Everybody is okay? My suggestion, memorize all the four. Memorize all the four, question can be asked. There is basic excise duty, SAED, special additional excise duty. There is the agriculture infrastructure development cess, and then there is, right, additional excise duty. All the four are imposed by the Government of India, collected by Government of India. What has been reduced by the government right now? The second one, special additional excise duty. And what is the benefit? Benefit is simple. Market prices are not going to go down. In fact, let the election results be announced, market prices will increase. For petrol and diesel, it is going to increase. But anyways, right now, what is the logic here? The oil marketing companies are not able to recover the full amount of their expenditure. They will have to increase the market price. Government of India says, keep the market price the same. I will reduce the special additional excise duty. Because you are keeping the market price the same, you will earn more amount of money. Right? A lot of money you will be able to generate. Your recoveries will be better now. That is basically the logic in the context of the taxes imposed by the Government of India on petrol and diesel. Everybody is okay? Sir, should we remember the numbers? No. My suggestion, don't remember the numbers. Remember the types of taxes. Now, in the context of fuel, there is one more idea, windfall tax. Remember this. This is important, windfall tax. What is this windfall tax? Whenever you generate more profits because of certain, right, events which are out of your control. I'll repeat the statement. Whenever your profits suddenly increase, not because of what you have done, not because of your careful planning, but because of something that has happened, right, beyond your control. For example, can I simply say, if there is an importer in India, crude oil importer of course, if there is a crude oil importer, because the crude oil prices or the refined products in the international market, prices are very, very high, they will import, let's say they will purchase from Russia, etc. at lower prices, and they will refine it and basically export it. They will refine it and export it. In the international market, the prices are very high. So your profitability, your revenues will increase, but not because of what you have done, not because of your policy planning, not because of your strategy, but because of something that has happened outside your control. So that sudden profitability that you generate, it is called as a windfall. Is it okay? That is basically windfall. right? On this particular windfall, the government will impose a tax and collect. That is called as windfall tax. Can I move on to the next concept? Do let me know. Everybody is okay? So central government has reduced a special additional excise duty to ensure market price of the crude oil will remain the same. Remember the four types of taxes. Most of them are excise. I know that. You also know that. But remember, basic, additional, right? And the third one is additional, special, additional. Basic, additional, special, additional. And the fourth one is agriculture infrastructure development cess. So three types of excise, one type of cess, right? And in addition to that, windfall tax. And if UPC will ask you this question, is it the first time that government of India has introduced a windfall tax? Answer is no. Earlier as well, the government of India, 2022. What is the importance of 2022? It was during Russia's attack on Ukraine. Right? It is basically during Russia's attack on Ukraine. So back in 2022 also, the government of India had introduced, right, the windfall tax. But that was later withdrawn. After 2 to 3 years, the windfall tax was withdrawn. Now again it has been reintroduced. Done? Everybody is okay? Please be very careful. Now let's move on to the next concept here. SIDBI, Small Industries Development Bank of India. SIDBI. Now what is the importance of this article? The government of India has announced equity infusion of 5,000 crore rupees. The government of India has announced equity infusion of 5,000 crore rupees into Small Industries Development Bank of India. There are multiple owners of SIDBI. Government of India is one of them. I'll repeat it. The owners of SIDBI, there are multiple ones. Government of India owns around 20% plus in the SIDBI. So Government of India now has announced that they will be infusing 5,000 crore rupees worth of equity in SIDBI. And what is the use of it? Please understand, SIDBI is a type of development finance institute. It is a type of development finance institute. And SIDBI is mainly involved in the promotion of MSMEs. Please remember this. It is mainly involved in the promotion of MSMEs, micro, small and medium enterprises. Jagdish Babu, my dear, please understand, is it on exporter? SIDBI is not going to promote exports. For exports, there is one more bank, Exim. For promotion of export, there is one more bank, Exim. And those are appearing for prelims, upcoming prelims. I've already done a video on covering all the regulatory bodies. I'll repeat the statement. I've already done a video covering all the regulatory bodies from SEBI to Reserve Bank of India, SIDBI, Exim, NABARD, etc., etc. If you are yet to watch it, please do watch it. If you don't have time to watch the complete video of around 40 minutes, at least download the PPT and go through all the 40 slides. Done? Okay. So what is the use of this? What is the objective that the government of India is trying to achieve? If SIDBI is strengthened, its functions will improve. For example, SIDBI, like I said, provides a lot of assistance for the promotion of MSME, micro, small, medium enterprises. So its lending activity through the banks to MSMEs is going to improve. And not just this, it is an all India financial institution. Please remember, SIDBI is also all India financial institution. So Reserve Bank of India has implemented certain Basel guidelines. All of you heard of Basel guidelines? So Reserve Bank of India has stated that the all India financial institutions, we have SIDBI, we have NABFID, we have NHB, we have NABARD, etc. All these all India financial institutions will also come under the Basel guidelines. That is essentially, they will have to maintain the capital adequacy ratio. They will have to maintain a capital adequacy ratio. So now you just think of it. If the owner will infuse the capital, if the owner will put in equity capital, don't you think the capital adequacy of this institution will improve? Done? Everybody is okay? So this will strengthen the flow of credit to the MSME. This will provide, right? The government will provide this 5,000 crore rupees over a period of 3 years. This will also help in maintaining a healthy capital risk weighted assets ratio, capital to risk weighted assets ratio, CRAR or CAR. It will provide, right, let's say stability to the institution. Then everybody is okay. Can I move on to the next one now? And one more benefit is, understand this carefully. If SIDBI is strengthened, if SIDBI is strong enough, if it has very good capital base, etc., if they want to borrow from the market, because it is more stronger now, it is more healthier now, it will be able to get access to more funding at lower cost. That is also very important point in the context of, right, SIDBI. Okay. DVLP, my dear, what is this DVLP? Where have I written DVLP? Ocean Samu. Please do let me know. Okay. Did I write DVLP anywhere? Okay, right. Okay, let's go forward. RBI secured data, right? RBI second secured data place, right? Or data center. Simple factual data point. Please remember this. RBI now, earlier already it has one data center. What is the use of a data center? RBI basically will keep all the sensitive information, all the sensitive servers, systems, etc. stored at one place. Simple, they will store at one place. They already have one data center, and this particular data center is in Navi Mumbai, Maharashtra. It is in Navi Mumbai, Maharashtra. But the Reserve Bank of India is worried, what if, hypothetically, what if the war breaks out? Correct? What if the war breaks out? Obviously, all these important centers, right, that is institutions, infrastructure, etc., might come under attack. One example I'm telling you. Don't simply think that, sir, you're promoting war. No, I'm not promoting war. Hypothetical possibility. Or else, what if there is earthquake, massive earthquake? What if sudden rainfall, flooding happens? Right? So there are a lot of instances where this only single data center that has been set up by RBI, which stores a lot of sensitive data, might be lost, might be damaged, etc. So the Reserve Bank of India, considering all of these particular factors, now has set up one more data center. Second data center has been set up in Odisha. Please remember this. The second data center now has been set up in Odisha. Can be asked in the preliminary examination. Please be very, very careful. So the sensitive systems, servers, financial data, etc. will be stored in the second data center along with the first data center as well. Right? So just factual information, please make a note of it. Next one, the issue associated with additional tier 1 bond mis-selling. Very recently, this was there in the newspaper. Additional tier 1 bond mis-selling. Right? What is this additional tier 1 bond mis-selling? Let me cover this. Then if you have any doubts, I'll address it. Let's start now. So what is this additional tier 1 bond mis-selling? Under the Basel guidelines, we have Basel guidelines, correct? So under Basel guidelines, each of the banks or each of these financial institutions which are covered under this, they will have to maintain a capital adequacy ratio, CAR, or capital to risk weighted assets ratio, CRAR. But the problem here is, if the banks will have to meet this particular capital adequacy ratio, they will have to collect more and more capital. Simple. They will have to, right, issue more, right, of these instruments, right? They will have to collect more and more capital. Now, in regards to this capital, there are two types. The capital is further divided into two parts. One is tier 1, and obviously the second one will be tier 2 capital. Okay, tier 1 capital and tier 2 capital. The tier 1 capital is the core capital. Core in the sense, the bank is more dependent on tier 1. The bank is more relying on tier 1. The tier 1 will absorb the losses much sooner, much earlier compared to tier 2 capital. Now the tier 1 capital is collected under two headings. The tier 1 capital is collected under two headings. One is called as Common Equity Tier 1, CET1, Common Equity Tier 1 and Additional Tier 1. Is everybody okay with the sequence? Common Equity Tier 1, issue shares. Equity means shares. Issue shares, collect the money. And then there is Additional Tier 1, which is collected by the banks by issuing bonds. And that is the reason these kind of bonds, which are issued to collect Tier 1 capital, these are called as Additional Tier 1 bonds. Is everyone okay as to why these bonds are named as Additional Tier 1 bonds? So the banks are allowed to issue Additional Tier 1 bonds. And I'm discussing specifically one type of a bond that has been issued of a foreign bank by an Indian bank. It has been sold by an Indian bank, but these bonds are of a foreign bank. Of course, I'm talking about the Credit Suisse. The Credit Suisse Additional Tier 1 bonds, which were sold by HDFC Bank to its customers. You don't have to remember the names of the bank, remember the concept. What is the concept here? Additional Tier 1 bonds are very risky. Is it okay? The AT1 bonds are very risky. Why? The rate of interest they offer is higher, no doubt, it is higher. But the risk that is associated with this is if the bank incurs losses, if the bank is in a financial distress, in such cases, first, it will cancel payment of interest. It will first cancel payment of interest. I'm using the term interest, they will use the term coupon. First, they will cancel payment of coupon to you. But if the stress continues and the bank reaches a position where if it continues to operate in the same way, it has to shut down. They will call this as point of non-viability. I'm using the technical term here. They will call this as point of non-viability, PONV. If the bank reaches the point of non-viability, in such cases, the bank, after getting the approval from the regulator, that is Reserve Bank of India, will either convert your bonds or cancel your bonds. Is it okay? They will convert or cancel your bonds. Meaning what? Imagine you're a bank. I've given money to you. I've purchased a bond from you. I've purchased the bond from you. You have incurred a loss. You will tell me that this year you will not pay any interest. I'll say okay, right? Part and parcel, because bonds means risk is there. And after some time, your losses continue to rise. You have reached a position where you can't continue to operate. You will approach RBI, get the approval from RBI, and now you will simply tell me that you will not be repaying the principal as well. Cancellation means what? You will not be repaying the principal amount as well. That is, in simple terms, the bond I'm holding in my hand right now is useless. It is simply a piece of paper. That's it. Right? That is essentially the meaning of, right, let's say cancelling the bond. Cancelling means the principal amount will not be repaid. So these are certain very important features associated with AT1 bond. Another very important point in the context of AT1 is that they do not have maturity period. Remember this. They do not have a maturity period. The tier 2 bonds have maturity period. These additional tier 1 bonds do not have a maturity period. They will be issued by the banks and they will be recalled. Recalled means when the banks want to repurchase it, it is decided by bank, the issuer, not by the buyer. Right? So these are also referred to as perpetual bonds. These are also referred to as perpetual bonds. Done? Right? So these are certain very important points in the context of AT1 bond. Now, will the UPSC ask you a question on mis-selling? No. AT1 bond mis-selling? Of course, no. What is the idea of a mis-selling? Mis-selling is a financial term which simply means you are, right, misrepresenting certain information to the investor and you are selling the product. That's the reason it is called as a mis-selling. Right? So a lot of investors of HDFC Bank, of HDFC Bank have complained to RBI that they were missold these additional tier 1 bonds. They were not correctly informed regarding risk. They were not correctly informed regarding the features of these particular AT1 bonds, etc. Done? Right? So these are certain important points in the context of AT1 bonds. Now, time is 8:10. If you have any questions, do let me know. I'll address your doubts. Otherwise, I'll continue the discussion. Huh? Any doubts? Please repeat tier 1 capital. My dear, the bank has to have money. This is called as capital. The capital is divided into two parts, tier 1 and tier 2. The tier 1 capital is more important for the bank. It is more important for the bank. Why? Tier 1 will absorb losses much sooner. Tier 1 will absorb the losses much sooner. If I want to explain to you in a simple way, I'm pretty sure all of you have ridden the bike or rode a bike. Whenever you're riding a bike, the tank meter, the tank meter will be on. First, the tank meter will show on, and then it will enter into reserve, correct? And of course, those people who are riding, let's say the Royal Enfield Classic will be more worried about this, because unlike a digital meter, they don't have digital meter. So logic is very simple. First, the fuel that will be at the higher level in the tank will be consumed. That is the on. And once, let's say all this fuel in the on range is consumed, the bike will enter into reserve. Apply the same logic. The bank, first, whenever they want to absorb the losses, they will use a tier 1 capital. Is it okay? If the bank wants to absorb the losses, first they will use tier 1 capital. And after they've used tier 1 capital, they will use a tier 2 capital. Is it okay now? At least now, is it okay? First, they will use tier 1. They will use this money to absorb losses. And after this, tier 2. And that is the reason under Basel III, the banks have been asked to maintain more and more of tier 1. The banks are supposed to maintain more of tier 1 compared to tier 2. Right? So under tier 1, you issue shares. You are issuing shares, collecting money. That is called as common equity tier 1. You are also issuing a bond and collecting money. That is called as additional tier 1. Here, the bonds are there in the discussion. Additional tier 1 bonds. Done? Can I go forward now? Sir, the funds collected under Agriculture Infrastructure and Development Cess will be used for AIF. There are multiple. AIF is also one of them. Most important one is AIF. Please explain the first point topic related to Financial Intelligence Unit. My dear, the exchanges, they cannot issue tokens. What do I mean by tokens? If you open a wallet with a particular exchange, they will give you tokens. Using the tokens, you can invest. So, basically the FIU says you're not allowed to issue these kind of, let's say, tokens to the investors who open wallet or account with you. Okay, anything else? Okay, let's go forward now. Let's go forward. Next important topic, risk-based, or before that. Sir, windfall tax is imposed on exporter who generates revenue from global advantages? Yes, my dear. Because of something that is happening in the international market, the exporter is getting the benefit. Exporter is earning more revenue. Government says, pay me more taxes, that is windfall tax. Okay, let's go forward. Risk-based premium framework. Sahil Suman, yes, my dear. Question is not about Mint newspaper. Question is about articles. Are the articles from the Mint newspaper covered? Of course, yes. If these are relevant, they will be covered. Let's go forward. Risk-based premium framework. Important one, listen to me carefully. The concept of, let's say, the premium, or let's say the idea of insurance. I'll go to the premium in a minute. Idea of insurance, whenever you keep deposits, has been in implementation. There is an authority, DICGC, correct? All of you heard of the authority DICGC? Deposit Insurance and, let's say, the Guarantee Corporation, DICGC. It functions under Reserve Bank of India. right? It is a subsidiary. It is a subsidiary of Reserve Bank of India. Now, DICGC, any entity that will get a banking license, DICGC provides insurance coverage. It will provide insurance coverage to whom? To the deposits which are collected. Deposits which are collected by the bank. Of course, not all the deposits, by the way. Please remember that also. Not all the deposits. What do I mean by all the deposits? Let's say interbank deposits are there. Will they be covered under DICGC? Answer is no. Let's say the central government or the state government will keep deposits. Will they be covered under DICGC? No. Right? So, lot of these deposits that we keep in different forms, in different ways with the banks, they will be provided with insurance coverage by DICGC. And the insurance coverage until very recently was up to 1 lakh rupees. Now this has been increased to up to 5 lakh rupees. Up to 5 lakh rupees. But of course, the discussion is not on the 5 lakh rupee now. Whenever the banks will get the insurance coverage, they will have to pay insurance premium. Correct? The banks will have to pay insurance premium. That is until now. I repeat, until now. Until now, the insurance premium was 12 paise for every 100 rupee deposits per annum. 12 paise, right? That is the insurance premium amount for every 100 rupees that is collected for 1 year. But the problem is, earlier as well, there were multiple committees which recommended that we should not have a flat rate of insurance premium. We should have differential rate. Differential rate, that is, all the banks are not conducted, are not operated at the same risk level. All the banks are not investing in the same risky instruments. All the banks are not incurring the same amount of losses. Then why should we collect the same amount of premium from all the banks? And that is the precise reason multiple committees, please memorize the list of the committees. My suggestion, memorize the list of the committees. There is a Jagdish Kapoor committee, M. Nachane committee, as well as Jasbir Singh committee. All these committees recommended a risk-based premium. Risk-based premium. Concept of RBP, risk-based premium. That is a differential premium. Have a framework where you will identify the banks based on the risk they are taking, based on the risky investments they are doing, and based on that collect a different amount of premium. And this has been implemented by Reserve Bank of India from 1st April 2026. This has been implemented by Reserve Bank of India now. So what has RBI done now? RBI has divided the banks. Please look at the table here. All of you, please look at the table. RBI now has divided the banks into 4 categories: A, B, C, and D. Until now, no concept of categories until now. That is before April. All the banks would pay a flat rate of premium. Going forward, this has been implemented now. Going forward, the banks will be paying differential rate of premium. And the premium is in the range of 8 paises to 12 paise. 8 paises to 12 paise. Right? Please remember this. Not uniform. The bank with the lowest risk will pay 8 paises. The banks which is classified as category D will pay 12 paise. Is everybody okay? In addition to this, there is one more concept. Vintage incentive. Remember this as well. Vintage incentive. What is this vintage incentive? Based on the stability that the bank has experienced. Stability in the sense, if the bank is stable, it will continue to work for year after year. Correct? If a bank is operating for 100 years, obviously it's a sign of stability. If the bank has completed 15 years, it's a sign of stability. So based on the stability that the bank is experiencing, it is called as vintage incentive. Please remember this. The Reserve Bank of India has also announced a vintage incentive. Meaning what? If your bank is completing 1 more year, you will get more discount under the insurance premium. Is my point clear to all of you? Do let me know right now. If your bank is going to complete a year of its operation, in addition to whatever insurance premium you're paying, now you will get a discount on the insurance premium. That is the maximum vintage insurance or vintage incentive that the RBI is going to provide. Under this mechanism now, that is a risk-based premium framework. Now, maximum will be 25%. Maximum will be 25%, right? And for every year that you complete, 1%, right, insurance premium discount you will receive. For 1 year, 1%. For the second year, 2%. For the third year, 3%. So what if I complete 100 years? RBI simply says, maximum I will give you discount is 25%. So what if I complete 50 years? RBI says, congrats, but the maximum, the vintage incentive will be 25%. You might say, I've completed 75 years. RBI says, congrats, maximum vintage incentive is 25%. Everybody is okay? Please do let me know. So one is, as usual, right, the new premium rate card, 8 paisas to 12 paisas. In addition to this, for every year of completion that you do, you will get an incentive, vintage incentive of 1%. And the maximum incentive will be 25%. What is the point again, my dear? If you're paying 25 paise, right, imagine, right, you're paying 25 paise. RBI, again, I know 25 paise is not there here, maximum is 12 paise. If you're paying 25 paise, RBI says you have completed 1 year, I will give you 1% discount out of 25 paise. Maximum how much discount can you receive? For 1 year, for every year that you complete operations, 1%. You have completed operations 2 year, 2%. 3 year, 3%. Maximum is 25%. Done? Everybody is okay at least now? Everybody is okay at least now, right? So these are the two very important changes. Please make a note of this. Somebody was asking, should we remember the name of the committees? My suggestion, please do. Memorize the names of the committees which have recommended this. Memorize, right, the structure that has been implemented, 8 paisas to 12 paisas, and also memorize vintage incentive. Memorize this vintage incentive as well. Okay. How the deposits over 5 lakh rupees will be secured? No, my dear. The maximum insurance provided by the banks will be 5 lakh rupees. And that's the reason, I don't know how many of you have seen this. Whenever you approach a expert, financial expert, who will charge money to give you advice, etc., they will basically say, split your deposits, split your bank deposits. Why? If you keep all of your deposits only in one bank, you are taking a lot of risk. Split your deposits amongst the different banks so that the risk is also minimized. Okay, let's go forward. Net open position, INR. Important one. Net open position, INR. NOP, INR. Slightly technical, please listen. Next 5 to 10 minutes, please listen. Stop whatever you're doing, because NOP, INR is slightly technical. What is this NOP, INR? First and foremost, please understand, financial institutions. Let's take example of a bank. The banks are involved in the market. Correct? Banks are involved in the market. Do not imagine that banks are only involved in lending activity. No, that is one aspect of bank's activity. There is also investments. For example, banks are involved in the currency market. They will buy currencies. They will sell currencies. This is point number 1. Clear? Point number 1. Point number 2, when these are involved in buying and selling of currencies, they will know there is a lot of risk involved. There is a lot of risk involved. What is the meaning of it? Let's say today I'm a bank. I will buy dollars. Imagine, today I will buy dollars. What if the value of the dollar suddenly falls after 1 week? What if value of the dollar suddenly crashes after 2 days, after 3 days, etc.? Don't you think I'm taking very high amount of risk by simply purchasing dollars? Of course, yes. So they will try to hedge the risk. Simple. they will try to hedge. Hedge means protect. Hedge means escape. They will try to hedge. So one, they will try to hedge from the risk, and there are certain banks who will try to speculate. Speculate means what? What if instead of falling, the value of dollar increases? What if the value of rupee also changes suddenly? I want to make profit out of it. Speculation. So there is hedging, there is speculation. What they generally do is, in addition to the spot market, in addition to the spot market, what is the meaning of spot market? Spot market, for example, stock markets. You buy and sell right now. Everybody is okay. You buy and sell right now. And when I say right now, do not imagine right now you will go to the stock market. I know closing hours are right. The opening hours are over. It is closed now. But when the market is open, you will sell the shares, you will buy the shares. Spot market. So in addition to being present in the spot market for the currencies, they will also focus on derivative market. Here comes the technicality. They will also be present in the derivative market. Now, what is this idea of a derivative market? Simple concept, don't overcomplicate it. Derivative simply means these are agreements. These are contracts. Contracts between whom? Contracts between two parties. Is it okay? These are contracts between two parties. Regarding what? They will enter into a contract today on the exchange they will do in the future. Is it okay? I'll repeat it again. In the derivative, they agree to a contract. They come under a contract. Regarding what? They will exchange. Exchange in the sense, one party will transfer an asset, another party will pay money. But that will happen on a future date. So the exchange that will happen on a future date, regarding that, the agreement is signed today. This is basically the derivative market. Everybody is okay? Sir, example. I'll give you a very simple example. Imagine you are a company which is manufacturing biscuits. I am a farmer who is cultivating wheat. I am worried, what if after 1 month when I'm about to sell the wheat in the market prices are very low. I'm worried about it. You are a company who wants to purchase wheat after 1 month, but you are worried after 1 month the wheat prices could be very, very high. So today itself, me and you both will enter into a contract. Both will enter into an agreement. And I will promise to sell you wheat at a particular price after 30 days. You also have a, right, let's say confirmation that after 30 days, you will get the wheat. I have the confirmation that after 30 days, I'll get this money. At least this logic is clear to all of you? Of course, yes. It's not this easy. Right? I hope you understand. Just to make you understand, I'm giving you a simple example, but in reality, it's not this easy. It's a very, very complicated market, derivative market. But please understand, just like I explained in the context of a wheat, can I simply say the banks, in order to speculate, the banks will speculate. The banks want to protect themselves. They will enter into the derivatives where currencies are involved. Very simple. They will enter into derivatives where currencies, that is, a bank will be selling dollar, will be purchasing dollar. They will use two technical terms here, long position and short position. Okay? Long position and short position. What is the simple meaning of a long and short? Long means you are buying. Short means you are selling. Is it okay? Long means you are buying. Short means you are selling. So let's say hypothetically, after 30 days, you will buy $100 million. That is the agreement. After 30 days, you will buy 100 million. And after 30 days, you will sell $10 million. Now, can I simply say, right? Listen to me carefully. Long means you are buying, right? And short means you are selling. So after 30 days, you are buying 100 million. That's a contract. And after 30 days, you are selling 10 million. Can I simply say, overall, your position is long and $90 million. Everybody is okay? Do let me know. Overall, assuming only two transactions, only two contracts have entered into. I repeat, assume these are the only two contracts have entered into. After 30 days, you will buy $100 million, and after 30 days, you will pay $10 million. So can I simply say your short as well as a long position simply is a net open position of $90 million. Net open position. Net open position means how much you are going to buy, how much you are going to pay. Is everybody able to understand? Do let me know right now. I know this is technical, I know it is complicated, but you don't overcomplicate it. After 30 days, you will buy 100 million, your long position is 100. After 30 days, you are going to short. Short means sell 10 million. So how much is your net position? Net means how much you will buy, how much you will pay. Net open position is $90 million. Is everybody okay? Now please think of it. Why will you buy dollars after 30 days? Why do you want to buy dollars after 30 days? Right? Can I simply say you want to buy dollars because you're worried rupee value will be lost. And moreover, you will basically try to hold more and more dollars because you don't want to keep on taking a risk by holding rupees. Because rupee will continuously keep on losing value. Rupee will keep on losing value. That is exactly what has happened. Rupee will keep on losing value, so you don't want to hold rupees. And later, let's say, instead of buying at $1 is equal to 90 rupees, right? Later, that is pay 90, 95, etc. to buy a dollar after 30 days. Today itself, we have entered into a contract. That is at 82 rupees, 85, 89 rupees, you will purchase. So logic is very simple. When there is a very high positive net open position, when banks will have very high net open position, that is $100 million open position, $200 million open position, $300 million open position. Why do they do that? Because they are worried that rupee is going to depreciate. Right? They are worried, that's a reason. Later purchasing $100 million by paying more number of rupees, today itself you have agreed, I will purchase $100 million after 30 days at this particular price. So what is the logic of, right, let's say all of this? Basically the banks, the financial institutions involved, if they have a very long position, if they are taking very large long position, it's an indicator that the demand for dollar is increasing. Supply of rupee is increasing. Rupee will further start losing value, etc. Is it everybody okay? Is everybody able to understand? Don't overcomplicate it. If you're taking a very big long position of dollars, it simply means you want to buy dollars. You don't want to keep rupees. You want to keep on buying dollars from the market, which means demand for dollar will increase. Dollar will appreciate. Supply of rupee increases. Rupee will depreciate. That's a very good indicator in the market. So Reserve Bank of India looked at the NOP of these financial institutions which had very, very big long positions, very large long positions. And RBI simply said, on any given day, the net open position of these financial institutions, that is, let's say banks, these financial institutions cannot have a net open position of more than $100 million. Is it okay? These financial institutions cannot have a NOP of more than $100 million at the end of the day. So what if I'm entering into a contract where more than $100 million value is there? Unwind it. That is basically move out of the contract. You cannot be if the value is already more than $100 million. Done? Right? So this is basically the policy that was announced by Reserve Bank of India very recently, in simple terms, to control the depreciation of rupee. To control the depreciation of rupee, this particular net open position INR limitation was imposed by Reserve Bank of India. Done? Can we go forward now? Can we go forward now? Do let me know. 8:35. Umesh Naik, can you tell me what is the topic? My dear, I'm discussing economics. My name is Sham Kagod. I'm the faculty for economics. And I'm discussing current affairs of economic subject from January to April 2026. Okay, let's go forward. One more derivative concept, total return swaps. How many of you find derivative, basics of derivative? Of course, I hope you understand. I'm not asking you to analyze candlestick patterns, etc. The basics of derivatives difficult. Because if a lot of you are feeling these concepts as very, very difficult, I'll do a very short video to cover the basics of derivatives. I don't want you to learn trading in derivatives, the basics of derivatives. What's a derivative? Features of derivative, types of derivative, etc. Okay, anyways, one more type of a derivative, total return swaps, TRS. Total return swaps, TRS. And this is one more derivative that was mentioned, by the way. Right, that was mentioned, by the way, in the budget. In the budget, this was mentioned. What is this total return swap? Listen to me very carefully now. Another 5 minutes. Technical now. Another 5 minutes. Total return swap is a type of a derivative. Right? Essentially, there are multiple types of derivatives. But the most important ones, you have futures, you have options. These are basically called as F&O, futures and options. You have forwards and you have swaps. Again, I'm saying these are the 4 important types. Apart from these 4, there are others as well. For example, you have swaptions as well. But focus on these 4. Futures, options, forwards and swaps. The last one that is mentioned here is swap. Total return swap. TRS. Total return swaps. What is this concept of a total return swap? Right, listen to me very carefully. Let's say there is a bank. This particular bank has invested and purchased a bond. I'm giving you one example. I'm just giving you one example, okay? So the bank has invested, purchased a bond. The bond is on the balance sheet of the bank. The bond is on the balance sheet of the bank. Now the bank will enter into a swap contract or a swap agreement with an investor. With an investor. Let's say I am the bank, you are the investor. What is a swap? The investor agrees to pay, right? Let's say a fixed rate of interest. The investor agrees to pay, right? Again, it could be fixed, it could be floating. It all depends on the contract. It all depends on the agreement. In this example, I'm assuming a fixed rate of interest. So the investor agrees to pay a fixed rate of interest to the bank. And the bank in return guarantees payment of coupon, that is interest to the investor, plus if there is any change, specifically appreciation in the value of the bond. Is everybody okay with this? Do let me know. I'll repeat it again. Imagine I'm a bank. I have invested, purchased a bond. It is on my balance sheet. Now you will enter into an agreement with me. That is a swap agreement or a swap derivative. According to this swap derivative, we are going to exchange. Swap means exchange. We are going to exchange the revenue streams. This revenue stream could be, you guarantee me a payment of interest. That is, annually you will give me so much percentage of interest. No matter what. You will give me so much percentage of interest. In return, I am guaranteeing, right, certain rate of interest that is on the bond. And, right, that is because I'm holding a bond. I hope you understand, sir. On what? Bond. I'm holding a bond, right? So on the bond, whatever rate of interest is there, let's say, I will guarantee you that. And if the value, that is the market price of the bond goes up, I will pay you the appreciated value. So you are going to pay me interest. I'm going to pay you the increased value of the bond as well as the coupon rate of the bond. This is basically called as a swap. Everybody is able to understand? Please do let me know. This is called as a swap. Total return swaps. TRS. Total return swaps. So the returns on both of the returns on the instruments. The instrument here is a bond. swap is happening between two parties here. I'm paying you the amount of coupon I'm earning on the bond, I'm simply giving you. If there is any increased value in the market price of the bond, I'm giving you. And in return, you're going to pay me, right, let's say a fixed rate of interest. Right? So we are swapping two different revenue streams. And I know somebody will be thinking, why are we doing it? The bank might be worried about falling value of a bond. Correct? Simple. Bank is worried about, let's say, falling value of a bond. If the value of the bond falls down, you will have to pay me. The bank is worried that the coupon rate on the bond could be lesser. But because I'm guaranteeing you the appreciated value of the bond as well as the coupon rate, I will get a fixed rate of interest, right, from you. I'll earn a fixed rate of interest from you. Right? So basically we are swapping, we are exchanging certain revenue streams. This is called as a total return swap. Done? Everybody is okay? This is there in the newspaper. Please be very careful. This is a type of a derivative. And specifically under the derivative, a swap. It is a type of a swap contract or a swap derivative. Right? So this is one more important concept that was there in the newspaper. Please be very careful. Let's go forward. Double Taxation Avoidance Convention, DTAC, between India and France. Double Taxation Avoidance Convention between India and France. What is the importance of this? Listen to me carefully. There is a concept called as a P note. This is associated with a P note only. There is a concept called as a P note. Right? Participatory note. What is the idea of a participatory note? A foreign investor, if they want to invest in India, they will have to take the approval of SEBI. Correct? They will have to take the approval of SEBI. But to take the approval from the SEBI, it might take a lot of time. So instead of waiting, instead of submitting all the documentation, the time consumption could be higher, etc. What the foreign investor will do is, they will approach a financial institution, let's say a broker, or let's say a investment company, etc., investment bank, etc. They will give the money to the investment bank, and this investment bank is already registered with SEBI in India. Right, sir, example, HSBC. HSBC is involved in these kind of, let's say, instruments only. So a foreign investor will approach HSBC, give the money to HSBC. HSBC is already registered with SEBI. They will invest in India's market using that money of the foreign investor. But the foreign investor should get certain security, right? Should get certain instrument. So the company HSBC will issue an instrument to the foreign investor, and that is called as a participatory note. And that is called as a participatory note. Everybody is okay with the term participatory note? In a nutshell, these are referred to as offshore derivative instruments. Offshore derivative instruments. Now listen to me carefully. A participatory note has been issued, and suddenly the government of India is announcing that the way it is going to impose a tax on it, that is a foreign investments, the way it is going to impose a tax on it will change. That was basically the gist of Double Taxation Avoidance Convention. The DTAC is basically a type of agreement between India and France, under which until now, the foreign portfolio investments that came from France into India, the tax on that was imposed and collected by the France authorities. Is it okay? Right? They will be imposing and they will be collecting the tax. Now this particular DTAC has been amended. It was signed back in 1992. It has been amended. According to this amendment, going forward, it will be the Central Board of Direct Taxes which will be imposing and collecting taxes on the foreign portfolio investments that are coming from France and are being invested in India. This is the update. This is the update. The DTAC which was signed between India and France has been amended now. The protocol for amendment has been implemented, and as a result of this, if the FPI, and again I'm using the term FPI, and some of you will be thinking, what is the connection of FPI with P note? My dear, P note investments in India right, will also come through FPIs, foreign portfolio investments. So these kind of investments which have come into India, now the taxation on these, the FPIs, will be imposed and collected by Central Board of Direct Taxes. What are the tax rates that have been announced? If the dividend tax on the French companies, right, have a look at this. The dividend tax on the French companies, that is those entities which have at least 10% of Indian equity, the dividend tax has been reduced from 10% to 5%. And for shareholdings under 10%, right, the shareholdings under 10% in Indian firms, the dividend tax will increase from 10% to 15%. Right, my dear Umesh Nayak, my dear, please revise. Logic is simple. India and France have a double taxation avoidance convention. According to this, if the FPI is going to invest in India, now somebody will say, sir, you're talking about FPI, then you're saying 10%. Please look at the Arvind Mayram Committee recommendation. The Arvind Mayram Committee recommendation says if your investment in the Indian market is up to 10%, then it has to be classified as FPI. Right? So FPIs will invest in the form of money that is collected by issuing P note. So according to the change that has been done now, the taxes on these investments that are done in India will be imposed and collected by Central Board of Direct Taxes. And what is the tax rate that the CBDT has announced? The dividend tax on the French companies. I said HSBC. Imagine, instead of HSBC, there is a French FPI which is investing in India. Right? So the dividend tax on these particular companies which are holding more than 10% in India, more than 10% in Indian companies, the dividend tax will be reduced from 10% to 15%. If they are holding less than 10%, that is up to 10%, then the dividend tax will increase from 10% to 15%. This is basically the changes in the tax rate, and this is the DTAC which has been amended by the CBDT as well as the French authorities. Done? Okay. Next concept. Right? My concern with some of the students, please don't take it in a negative way. I'm concerned about some of you people. Why? The terms FPI, the CBDT, the DTAA, right, or for that matter MFN, etc. These particular terms, you should be aware of it by now. I'm not scolding you. I'm not reprimanding you. Please don't take this in a negative way. I'm only worried that this is basically the current affairs from January to April, which means you should have read all the basics of taxation. You should have read BEPS, what is DTAA, what is, right, let's say treaty shopping, right, etc., etc. My only concern is some of you have not read it. Okay. Jagdish is asking how France is benefiting. My dear, who said it is for benefit of France? Did I say it is to benefit for France? In that way, you could have asked how Mauritius is going to benefit under amendment in 2017. It's not about benefiting other countries. You know you are losing tax receipts. So you will amend this convention and you say you will be imposing these kind of taxes going forward. It's not about benefiting them. It is about benefiting us. Okay. Anyways, let's go forward. E-Rupee powered PDS pilot launched. Important point. There are two concepts. A pilot has been launched in the context of E-Rupee. E-Rupee here is CBDC. Central Bank Digital Currency. Central Bank's digital currency. Right, so for the first time ever, the government of India has implemented a pilot project in some of the places in Gujarat. What is the pilot project here? Let's say I'm a beneficiary who is getting food grains under the PDS system, Public Distribution System, PDS. But there is a concern, right? There is a concern that the shopkeepers, that is the fair price shop owners, are not giving the right quantity of food grains. The beneficiaries are not getting the right quality or the quantity of the food grains. Right? There is a cheating, etc. involved. In order to address the problems faced in the PDS by the beneficiaries, the government of India has implemented two pilot projects. One is basically the CBDC powered PDS pilot, and the second one is, right, the food grain ATM. I'll come to this. First, let me cover the first important reform. That is CBDC, e-rupee powered PDS pilot. First time ever this has been launched. What is the concept here? The beneficiaries will be asked to open a wallet. RBI approved wallet. RBI approved wallet. And those who have, I'm pretty sure you'll know this. If you want to have e-rupee, I'm talking about CBDC of course. If you want to have e-rupee from your bank account, you cannot directly have it in the bank account. You will have to open a wallet. Correct? All of you know this by now? You cannot have within your savings bank account, you can't have e-rupees. You will have to open a wallet and transfer this money into this particular wallet, and this wallet will be e-rupee wallet. E-rupee will be, right, the CBDC, Central Bank Digital Currency. Now listen to me carefully. RBI approved wallet will have to be opened by these particular beneficiaries. Now the government of India will transfer the CBDC, that is simple terms money, CBDC, that is e-rupee, transferred into this particular wallet. I will take the wallet, that is mobile phone, to the PDS. I will scan and I'll transfer the money, that is the subsidy amount. I will transfer the money, right? I'll scan and transfer the money, and I'll now receive the food grains from the ration shop. Everybody is okay? Now I will receive the food grains from the fair price shop or the ration shop. Right? This is basically the new system that has been introduced by the government of India. Now those who are wondering what is the benefit of it, my dear, if you are the government, will you not be able to identify who is the beneficiary under this system? Do let me know. Will you not be able to identify the correct beneficiary under this particular system? Will you not be able to track where this particular wallet has been utilized? And this particular e-rupee that has been transferred into the wallet, these are programmable, by the way. Programmable in the sense, these are the rupees which can be used to purchase only the food grain from the ration shop. These can be used only at the fair price shop. How much quantity can you purchase? That is also determined, right, in this, that is also programmed in the e-rupee. So the government of India simply says that I will be able to make the system of direct benefit transfer, the DBT, direct benefit transfer, I will be able to make this particular system much more efficient. I will be able to make this particular system much more, right, let's say target based. I will be able to target the right beneficiaries. I'll be able to track where they're using this particular e-rupee, how much they are purchasing, are they getting the right benefit or not, etc. All of this is the benefit of e-rupee powered PDS pilot. Right? All of these are the benefits of e-rupee, right, a PDS pilot. What is PDS? PDS, my dear, public distribution system. Umesh Naik, public distribution system. It is basically referring to a system which has been established by the government where the fair price shops are established and the beneficiaries will get access to, right, let's say food grains. If the government of India wants to provide food grains, which is done right now by the government, 5 kgs of free food grains, they will get access to these particular food grains from the PDS system. Okay, done? Everybody is okay? Now, next one, food grain ATM. Food grain ATM. And before I go forward, please understand, the CBDC, anybody tell me in the class right now, which is the first CBDC in the world to give you interest rate? I'll repeat the statement, right? Which is the first CBDC in the world to offer interest rates. Right now, if you transfer if you transfer your money into your wallet, CBDC wallet, you don't earn interest on this, by the way. So my question is this to all of you, which is the first CBDC in the world to offer interest rates? This was also there in the current affairs, by the way. Next one, Annapurti ATM, Annapurti food grain ATM. Right, I'll tell you the answer in a minute. Just think of it. Annapurti food grain ATM. What is the concept of Annapurti food grain ATM? Simple. Even before this also, food grain ATMs have been implemented. But this is being done, right, in Gujarat now. Food grain ATMs are essentially machines. Whenever I want to get the 5 kgs of free food grain, I will have to go to ration shop. I will have to wait, right? The queue could be very long, right? And there is no guarantee whether correct quantity of the food grain is issued to me, etc. Instead of all of this, what if a machine is installed? I will go identify myself. For example, let's say I'll provide my thumbprint, I will provide my Aadhaar, etc. I will identify, and the machine will basically check the database and identify me as a beneficiary. Now, 5 kgs of free food grains, which are supposed to be given to me, will be disposed from the machine in bag. Right? In bag, 5 kgs of food grain will drop. I'll take the food grain and move away. This is basically the concept of food grain ATMs. Annapurti Food Grain ATM has been launched in Gujarat now. It is an automated dispensing machine which will operate 24 bar 7. That is also a benefit, because fair price shops are operating only for certain time period. What if you want to go for daily wage? You're working in your field, right? Either you can go to the work or you will have to go to the fair price shop. There is always a dilemma like this. From March 2026, the beneficiaries will be able to collect 1 kg packets of tur dal, chana, sugar, salt along with 25 kgs of wheat and rice. This is basically the point associated with the Annapurti Food Grain ATM. Can we move on to the next one now? Everybody's okay? Okay, there is a question. What about the check on shop? My dear, what kind of a check are you talking about? If you're asking me, sir, in case of shops, is there any mechanism to check? Yes, right. There is a mechanism, but lot of let's say data manipulation is done there itself. And as far as the question that I've asked, only a couple of you have tried the answer. The correct answer to which CBDC will give you interest. Is there any CBDC which will offer interest? That is China. China's renminbi. China's renminbi, that is CBDC, right? The digital currency there. They have become the first country in the world to offer interest rate on the CBDC, right? Whereas other countries, they are not offering, because you are simply keeping the money in a wallet. You're simply keeping the money in a wallet. They are not offering you rate of interest. Okay, let's move on now. Euro Currency Union. Bulgaria becomes the 21st member of the European Union Currency Union. Please listen to me very carefully. Lot of you are generally confused. European Union is basically group of 27 countries. Is the first point clear to all of you? European Union, it's a group of 27 countries. It's a union, of course, is. But all the 27 countries do not use the same currency. I'll repeat the statement. All countries do not use the same currency. There are some countries which are not using the same currency as it is used by most of the other countries. Until now, there were 20 countries which were using only one currency. Of course, that is euro. Right? Of course, that is euro. Only one currency, uniform across all the countries. Whereas the other 7 countries, they were using their own currencies. But now, Bulgaria has become the first country, 21st country, not first, right? Bulgaria has become the 21st member or the 21st country within the European Union to basically adopt the European Union Currency Union. Meaning what? It will also start using the same currency that is being used by the European Union Currency Union or European Currency Union. Is everybody okay? Straightforward question can be asked in this. Please be very, very careful. All the countries in the European Union do not use the same currency. A lot of them use their domestic currencies. But 21 countries now with Bulgaria, 21 countries basically have become a part of the European Currency Union. That is basically same currency will be used by all the 21 countries. Done? Okay. Next important article. GSP, bulk of India's exports, lose the GSP benefits that European Union was providing until now. I'm pretty sure yesterday you have attended Chetan sir session. Chetan sir has discussed the FTAs, etc. But there is one aspect that was there in the discussion in the context of India and European Union. That is the concept of generalized generalized system of preferences. Generalized system of preferences, GSP. Now, what is this generalized system of preferences? Simple logic, listen to me carefully. Under the World Trade Organization, there is one principle which is called as most favored nation. MFN, most favored nation. What is this idea for most favored nation? One country has to treat all the other trading partners in the same way. Simple. Don't overcomplicate it. It is basically a principle of non-discrimination. The way you are treating one trading partner, you will have to treat all the other trading partners in the same way. Right? This is basically the most favored nation principle. But are there exceptions to the MFN principle? Of course, yes. One of the exception is the concept of generalized system of preferences, under which the developed countries, I repeat, the developed countries provide certain benefits to the exports which are done by developing countries. Is the point clear? The developed countries provide certain benefit to the exports that they are receiving from the developing countries. Developed and developing is important here. Why? Under the GSP, a developed country cannot provide the benefit to another developed country. It can only provide this kind of a benefit to another developing country. They will also use the term donor country and beneficiary country. Donor country and beneficiary country. Right, so the developed country, for example, USA, United States of America, right, the European Union now, although it is not just one country, group of countries. So these particular countries will identify developing countries such as India. And the exports that we are doing, they will identify certain exports and they will reduce or eliminate the import duties. They will reduce or eliminate the import duties or tariffs. Right? This is going to provide benefit for a developing country because its exports now will become less costlier. Its exports will become competitive. They can trade more and more with a developed country. This is basically the concept of GSP, generalized. My dear, the full form is there at the top. Please have a look at it. Generalized system of preferences. GSP, generalized system of preferences. Done? Everybody is okay? Please do let me know. Now, what was there in the current affairs? As such, the GSP has been there in the newspaper for some time now. Back 2016, when Mr. Donald Trump was the president for the first term, right, during the first term, they identified that India is not providing the same benefit to, right, let's say certain companies' exports which are coming from USA. They basically criticized India's policy for this and stated that they would withdraw the GSP benefits that have been given to India. They have done that. India is not given the GSP benefits by America even today, although that is one of the discussions. But in addition to this, European Union, which is one of the major trading partners with India, they also have reduced or basically withdrawn the GSP benefits that they provided to India's exports. But some of you will basically think of this way. Of course, right? Prelims done now. Some of you will be thinking, but anyway, sir, India and European Union have signed a free trade agreement. Correct? You'll be thinking this way. Right? India and European Union have signed a free trade agreement, which means, right, even though they withdraw the GSP benefits, India's exports will not be hurt by much. My dear, listen to me very carefully. No doubt, India and European Union have signed an FTA. But according to various experts, the implementation is going to take time. The implementation of this is not going to happen at least for one more year. But till then, if European Union will withdraw the GSP benefits, India's exports will be hurt. Correct? Everybody is able to understand? So on one side, the agreement has been signed, GSP has been withdrawn. Agreed. And the argument of European Union is these products to which I provided the GSP benefit, these are competitive now. They don't require the kind of support that I'm providing for other developing countries. These are competitive. So I will withdraw the GSP. So yes, they have withdrawn. But at the same point of time, the agreement is not going to be implemented immediately. It is going to take time. Till then, India's exports, which have lost the GSP status, will be hurt. Then everybody is okay? Please do let me know. Next concept. Some of you are wondering, sir, break. No break. Right? Let's continue the discussion. We'll complete the discussion and then we can take the complete pause, right? A complete stoppage of the session rather than taking breaks in between. All of you are on the board for this? Please do let me know. All of you are okay with this? It's democracy, by the way. If you simply say, no, sir, right, I need a break right now, etc., I'll give a break. I don't have any problem. But I feel we should continue. Let's continue. Let's finish off the session. Then download the notes, download the PPT and start revising. Okay, let's go forward. European Union Mercosur deal. This was also there in the newspaper. European Union Mercosur deal. Right? What is the importance? Once this particular deal will come into force, these two regions put together, this will be the largest trading blocks in the global market. These will be, right, the largest trading blocks in the global market. So European Union Mercosur trade deal. Right, so European Union, already all of you know this, there are 27 member countries in the European Union. Mercosur is a grouping. Mercosur is essentially a grouping. Right, so we have Bolivia in this. Bolivia very recently has become a full-time member. Okay. Apart from this, we have Argentina. We have Brazil. We have Paraguay. And we have Uruguay. Right? In fact, Venezuela was part of the Mercosur, right? That has been suspended. So European Union Mercosur trade deal was negotiated long time back and finally the trade deal has been signed. Right? And what is the importance? Simple. The importance is that once the trade deal will be implemented, in fact, there was opposition from some of the countries within the European Union. Some of the countries opposed this particular trade deal. The reason that they cited was, if you start, right, basically after signing the trade agreement, if you start importing, these particular countries are known for their agriculture activity. In South America, these countries, especially Brazil, by the way, these are known for their agriculture activities. So the farmers in the European Union protested. Many of the countries also protested. Right? But even then, this particular agreement has been signed for a simple reason. This will provide a channel for these two groups of countries to trade. And this is important, especially looking at the fact that these countries or the groups earlier had a lot of trade that they did with other countries such as USA. With the kind of protectionist policies that are being implemented by USA, it makes more sense for the countries to sign these kind of other trade agreements. But anyways, for prelims, my suggestion, remember the name of the countries within the Mercosur grouping. Okay. Now, next one. Next important topic. Somebody was asking how many topics are left out. I think 10 topics are left out. Right. I think 10 more topics are left out. Let's cover all of them. Then we will basically stop the session. Okay. Next topic. Where is that? Trump tariffs. US Supreme Court rules them illegal. Trump tariff, US Supreme Court rules them illegal. Important point. Not the idea of, right, let's say Supreme Court ruling, how the process happens, etc. But please memorize under what provisions the Trump is imposing the tariff. Under what provisions Mr. Donald Trump has announced the tariff. Right? Please understand those particular tariffs which were earlier announced by Donald Trump under IEEPA, International Economic Emergency Powers Act. Right? International Economic Emergency Powers Act. If the tariffs were announced under IEEPA, these particular tariffs were ruled as illegal by the Supreme Court. Is it okay? Right? These tariffs were announced as illegal. But the US administration has not imposed tariffs only under the provisions of IEEPA. there are other provisions also which have been used by the Trump administration. Please memorize those particular provisions. For example, the Trade Act, right? The Trade Act of 1974. Right now, Mr. Donald Trump is quoting lot this particular, right, Trade Act of 1974. The 10%, 15% that has been announced is basically using the provisions of Trade Act of 1974. So one is IEEPA. In addition to this, there is a Trade Act of 1974, Section 122 can be used. Section 338 of Trade Act of 1930 can be used. Section 232 of Trade Expansion Act of 1962 has been utilized. And there is also Section 301. In fact, very recently, focus on the last point here. In fact, very recently, the US administration, specifically United States Trade Representative, USTR, United States Trade Representative has started Section 301 investigations. Section 301 investigations, right, involving India. I'm not saying only India, involving India. There are multiple countries against which USTR has started investigations under Section 301. Right? Their logic is India along with many other countries. In fact, one of the investigations simply says India along with many other countries has invested, has provided lot of subsidies which has led to overcapacity. This has actually led to overcapacity. And because there is overcapacity, the production is very high. And these particular products are exported to USA at cheaper prices, at lesser prices. And right, because of the Indian government subsidy policy, right, the cheaper imports are landing into America. And that is hurting, right, the USA manufacturers. That is in fact one of the investigations which has been started. There's a second investigation also where it simply says India has not taken sufficient measures to prevent imports from those particular countries where there is usage of forced labor. Where there is usage of forced labor, the imports from those particular countries are continuously coming into India, and the government of India has not taken sufficient protection by basically prohibiting these imports. So these are the two, right, let's say investigations which have been launched by the American administration, that is USTR, citing Section 301. Done? Can we go forward now? Can we go forward? My suggestion is please memorize all these sections, right? Not the complete paragraph that I've given, sections at least, and which falls under which act. What kind of question can be asked? As simple as match the following. As simple as match the following. Or they can ask you which of the following sections can be used by the US administration to impose a tariffs on exports from other countries. That kind of question can be asked. Saurabh Raghuvanshi is saying Chetan sir has already covered it. Okay, good then. I'm revising it. Right, so Chetan sir has covered it. I'm revising it. And actually, I'm thankful that Saurabh is not saying, sir, are you not Chetan sir? Because some of the students generally get confused. Anyways, let's move forward. RBI issues liberalized ECB rules. Right, RBI has issued liberalized ECB rules. What are the important points? Let me explain this. ECB basically stands for external commercial borrowing. External commercial borrowing. Right? What is the important point that you need to remember in the context of this? External commercial borrowing comes under the regulation of Reserve Bank of India, RBI. It comes under the regulation of Reserve Bank of India. Reserve Bank of India during the period of pandemic had increased the limit of external commercial borrowing. Until now, it was limited at $750 million per year. Right? It was up to $750 million per year. This was doubled to $1.5 billion per year. But please understand, this was for a limited time period. Limited time period. Right? Because there was a pandemic. There was a pandemic. There was a concern because of, right, let's say increased current account deficit. There was increasing fiscal deficit as well. So there was an issue that there could be a twin deficit problem in India. So in order to basically reduce this kind of a pressure and ensure the current account deficit, right, pressures will reduce, the Reserve Bank of India during the COVID time period had doubled the ECB norm from 750 million to 1.5 billion. That, right, the time period is over now. So Reserve Bank of India now has made certain changes. What are the important changes? Point number one. Now under the external commercial borrowing, you're allowed to borrow up to $1 billion. Please remember this. Up to $1 billion or up to 300% of your net worth, whichever is greater. I'll repeat the statement. Under the latest policy announced by the Reserve Bank of India, under external commercial borrowing, you can borrow up to $1 billion or up to 300% of your net worth, whichever is greater. And net worth basically means what? Difference between your assets and liabilities. Difference between your assets and liabilities. That is the basic idea for net worth. This is the first very important change. Second very important change, until recently, there was a ceiling. There was a ceiling that was imposed by the Reserve Bank of India regarding what is the rate of interest that you are offering. The rate of interest that you offered, basically meaning what? If you are borrowing under the external commercial borrowing, let's say you issue a bond, you'll have to pay a rate of interest. You take a loan from a foreign bank, you'll have to pay a rate of interest. So Reserve Bank of India mandated a maximum ceiling for the rate of interest. And this was a problem. Problem because a bigger company, a larger company, when they borrow under the ECB route, because they are very large, they will be able to get better rate of interest. That is, they will negotiate and get a better rate of interest. But if you're a smaller entity, you want to negotiate, you want to borrow from the external market, you don't have that much power. So you will find it very difficult to borrow at a lesser rate of interest. And if you want to borrow by paying a higher rate of interest, RBI has imposed a restriction. You're not able to meet that particular condition. So it was very difficult for the smaller entities, smaller companies to borrow by meeting this regulation. So what has the Reserve Bank of India done now? It has removed the ceiling over the rate of interest. That restriction over the rate of interest has been withdrawn by Reserve Bank of India. You want to offer a rate of interest which is market driven, you can offer under the ECB and you can borrow. In fact, very recently, the RBI has also stated that if an entity is under the corporate insolvency resolution process, if an entity is under the corporate insolvency resolution process, even they can go for the borrowings under the ECB route. They can borrow under the ECB route, right? In addition to this, please make a note of this as well. The eligible borrowers shall raise ECB with minimum average maturity period. They will write it as MAMP. If it is mentioned in the UPSC exam paper, don't get confused. Minimum average maturity period. MAMP of 3 years, right? Companies involved in manufacturing sector are allowed to borrow in 1 to 3 year maturity period, provided the outstanding amount does not exceed 150 million. Right? So this is the condition associated with the maturity period of the borrowing. Done? Right? So these are the changes that the Reserve Bank of India has announced in the context of the external commercial borrowing. Now let me move on to the next article. The deep tech startups. Please remember the change in the definition now. Change in the definition. The Department for Promotion of Industries and Internal Trade, DPIIT, is responsible for the Startup India policy. It is the nodal authority for Startup India policy. DPIIT in turn works under Ministry of Commerce. Ministry of Commerce. Now, in the context of the startup, one of the points in terms of definition, how do you define a startup? Right? The DPIIT uses 3-point formula or a 3-point, let's say, definition. You'll have to be right at the younger than the date of registration. From the date of incorporation, your company should be lesser than 10 years old. Annually, your company should have not generated a revenue of more than 100 crore rupees. This particular number now has been changed. This particular number now has been changed, so please be very careful. The startup now, the criteria for any other normal startup, normal one startup, the criteria is 200 crore rupees. Until now, it was 100 crore. Annually, your turnover should not be more than 100 crore. Now that number has been revised upwards to 200 crore rupees. But for deep tech startups, that is those companies or the startups which are going to invest in new age business, they are going to invest in, right, let's say breakthrough technologies such as artificial intelligence, etc. For the deep tech startups, definition has been changed. The regulations are different. Please remember this. The DPIT states that they will have to get the certificate from DPIT. They want to be recognized as a startup, that's a deep tech startup, they will have to get the certificate from DPIT. But for this certificate to be issued, they will have to have a turnover of less than 300 crore rupees. And from the date of incorporation, the entity should not be older than 20 years. It should not be older than 20 years, which means from the date of incorporation, it should be below, right, the age of 20 years. So 300 crore and 20 years. Please remember this. This is essentially the change for deep tech startups. In addition to this, the deep tech startup should be concerned with producing solutions based on the latest advancements. They should have, right, they should have invested most of their money in R&D activities. And they should also own certain intellectual properties such as patents, copyrights, etc. They should own or should be in the process of owning the intellectual property rights. So these are some of the very important conditions that the DPIIT has, right, basically notified if you want to be recognized as a deep tech startup. And the government of India is more focused on promotion of deep tech startups, by the way. I'll give you one more example. Please have a look at this. There is basically, right, a Department of Scientific and Industrial Research, DSIR. The DSIR basically provides, right, there is a program. Lot of incentives are being provided for the deep tech startups now. There's a program, IRDPP, Industrial Research and Development Promotion Program, under which the ministry or the department essentially provides a financial assistance of up to 1 crore rupees. But for this, until now, the condition was you should have a financial viability, right? That is, you should basically display that you are having a model which will help you attain a financial viability for at least 3 years. That particular condition, that is, right, a sustainable, viable model for at least 3 years, that particular condition now has been withdrawn. Right, this 3-year viability condition has been withdrawn, which essentially means a lot of these deep tech startups, they had invested money, they have a model, but it is very difficult to prove that this model will help them remain financially viable, financially sustainable for the next 3 years. It's very difficult to prove. Right, so a lot of these startups were not able to get access to financial assistance provided by the department. So Government of India has withdrawn this particular condition now. So please remember the department which is providing this financial assistance, how much is the financial assistance, and what is the name of the scheme. All the three can be put in a form of a statement and, right, asked in a, right, 3-statement MCQ. Okay, let's go forward now. First, tailing policy. Please be awake. I know it's been 2.5 hours almost 2.5 hours. I know a lot of you are fed up, a lot of you are feeling sleepy. So please be awake. Couple of more articles, then we can close the session, don't worry. First, tailing policy. The central government has announced for the first time ever a tailing policy. What is this tailing policy? Tailings are leftover waste materials. These are leftover waste material, because a lot of these critical minerals, mind you, these are available in very small quantities. And when you're mining for, right, some other mineral, right, a lot of times a very small quantity of another mineral is also present. So generally the focus is on the mineral which is available in larger quantity. We are more focused on, right, getting that particular mined out. And lot of these, right, let's say small quantity minerals which are present, these will be considered as waste. These are called as tailings. These are called as tailings, right? So the government of India in recent times has announced a lot of measures, a lot of reforms to promote production, refining, right, or even recycling of critical minerals. For the first time, the tailing policy also has been announced. So under this, the guidelines have been announced where critical minerals, right, which are available, right, as a primary source or secondary source, right, within the mine dumps, that is in the waste of other mines, now will be estimated, and we are going to extract these particular critical minerals, right, even though they are considered as a waste or a dump from, right, another minerals. Done. So the government in the last budget has announced this particular policy, and which entity has been given the responsibility to estimate what tailings are present in which mines, etc., etc. The entities or the authority is the Indian Bureau of Mines, IBM, Central Mine Planning and Designing Institute, and Atomic Minerals Directorate. These are the entities which have been given the responsibilities, essentially, essentially, right, to estimate what are the tailings present in which sources so that we can extract it. Done? Can we move on now? Next article. Pawan Chowdhury, feeling hungry. My dear, I'm also standing here, right, by the way. I'm also feeling hungry on a lighter note, but, right, so don't worry, we'll complete this. Okay, 100% FDI in insurance. 100% FDI in insurance has been announced by the government. Earlier, right, it was 26%. NDA government increased it to, right, 49%. Sorry, UPA increased it to 49. Then it was increased to 74. And finally, now it has been increased to 100%. The FDI in the insurance has been increased to 100%. But what are the important points? Let's not worry about the impact of it, evaluation of it, etc. Let's focus on, right, the important points for prelims. First and foremost, this announcement, right, has been implemented with the passage of Amendment Act. Sabka Bima, Sabki Raksha. Please remember, Sabka Bima, Sabki Raksha, Amendment of Insurance Laws Act of 2025. So this particular, right, law is going to amend. Right? It is an amendment law. It is going to amend which other laws? It will be amending the provisions under Insurance Act of 1938, Life Insurance Act of 1956, Insurance Regulatory and Development Authority Act of 1999. These are the three laws which will be amended with the passage, or which have been amended with the passage of the 2025 Act. In fact, please look at this within the larger picture of Government of India. The Government of India, along with the Insurance Regulatory Development Authority of India, have been focused on making insurance products more and more accessible. For example, the Government of India has reduced the GST rate applicable on insurance, right? The Insurance Regulatory Development Authority has announced Bima Trinity, right? So objective is very simple. The insurance penetration in India is very, very poor. So we need to ensure more and more accessibility is provided, right? More and more types of insurance products are, right, announced, provided, etc. Right? So in that particular context, please look at the 100% FDI in insurance. The Act allows up to 100% FDI through automatic route. Through automatic route for the foreign insurance companies. But there are certain important conditions as well. If a foreign company will own 100% of this entity in India, the top leadership, for example, the CEO has to be an Indian, right? The CEO has to be an Indian. The top management or the top leadership of this particular company, such as chairman, such as CEO, etc., have to be selected from Indian pool itself. You can't bring a foreign CEO and set up. Not allowed. Second, if there are entities which are involved in insurance and they are also present in non-insurance business, until now the merger was very, very difficult process. Now the particular process has been simplified. The mergers are being promoted or easily allowed. Insurance company along with non-insurance companies. Same parent company has two different businesses. Now you can merge. Third one, for the protection of the policy holders, the law also states that there will be a policyholder education and protection fund. These particular funds will be used to spread awareness amongst the investor or policyholders or, right, let's say customers of the insurance companies. The policyholders' data would be collected and protected under DPDP Act of 2023, Digital Protection Act of 2023. And have a look at this. The Insurance Regulatory Development Authority of India also has